In the wake of the Brexit vote, sterling lost almost 15% of its value against the US dollar at its worst trade. It's currently down about 11% from the pre-EU referendum vote level. But now discussing the prospects for a further leg lower on pound dollar, Ron William is the Senior Technical and Market Timing Strategist for the Multi-Asset Research and Advisory Team at ECU Group. Joined us now. Ron, welcome.
Happy sterling greetings.
Yeah, we've spoken about this before, about the way in which the markets have been moving, and leading up to the vote. The vote, of course, turned out completely opposite to the way a lot of people thought it would do. And there's been a lot of market volatility. I know you want to talk about sterling particularly today in the wake of the referendum vote. First of all, let's talk about the way you're approaching this trade.
Yes, well, it's through the eyes of the actual price charts themselves and the timings of those charts and the sentiment, the underlying sentiment. And what we see here now today is this much needed welcome rally from oversold territory after a historic cliff drop post-Brexit of about 15%, 12% actually on the day and 15% net. And if we look at the chart, we can see that certainly there are some key price levels to watch out ahead of the sentiment change with our new Prime Minister coming into office and the BOV rate cut expected later on this week. The key levels are 135.35, the June 29 high, and then a key pivot level which is the halfway point of the Brexit sell-off at 140.130. So these are key upside targets for maybe some intraday or multi-day traders to keep in mind. But from a tactical perspective, my view and the team's view is for a potential selling opportunity at any of these levels in line with the price fall that we've seen. So new lows yet to come, and the charts following here will show that.
Yeah, all the way down to 115, which is quite a distance away from where we are at the moment. Just explain what the bottom chart shows us as well with that scooping arrow that you've got.
Well, that shows the extent of the oversold nature of the market. So we're looking at the RSI momentum indicator there, unwinding from oversold conditions. And what's important also is the price pattern, the two-way volatility that we may now see at the moment, which we did see before and after Brexit. So it's the usual buy on the rumour, sell on the fact. We had the Remain camp buying in for a move of up to 7%. And then when the actual opposite fact did come out, it was a 12% drop, as we just mentioned. The same thing could happen now, but with a different rhyme. Now we're talking about kind of positive respite with the new Prime Minister and central bank policy. But be wary of that rumour and the consequential facts as there's a two-way volatility setup which might resume to the downside. Okay,
let's look at your second chart, because you're talking about the cause and effect, I believe.
Yes, well, I mean, this is important whether you're looking at technical analysis or any other types of market analysis. And there's a lot of sound bites being relayed as Brexit may be causing somewhat of a bullish or bearish reaction in the market. And of course, in the short term, it does. But as a technician, or anyone looking at the chart, we must keep in mind that the bear market, certainly in sterling terms, sterling cable, was down for 2 years. So that negative sentiment was already in play, and that did create asymmetric risk and a negative social mood in the market, and potentially some might suggest the outcome itself of a Brexit. Now, price terms, that downtrend was down, but what that suggested was a collapse below that 30-year support level, which we did get ultimately. And in our last interview, that's what we were looking at before Brexit actually did take place. That 15% drop followed. And in timing terms, there was an 8-year cycle in place, which has been in place for the last 40 years, and for that duration has correctly highlighted all of the major bottoms in cable. Now, this cycle had suggested, and still does, further risk into the second half of this year for cable. So price and time technical setups that were suggesting further negative downside for sterling, but then also ahead of the Brexit vote itself. So something to keep in mind.
As part of your analysis, I know that you were looking at the historical price slumps, the percentage moves. When we bring up the next chart, I think you've got a list of numbers. Explain exactly what's happening here and what we take from this list of declines that we've seen for sterling.
Well, history always gives us some interesting lessons, and on this table that we have here, it's just a simple measure of all the major price slumps on sterling dollar over the last 30 years. So for the duration that it's been in that very wide trading channel that we saw in the previous chart. And what that shows is that the average price, major price drawdown is minus 21% or 20%, just to round it off. And the number of months that move usually takes place, not just the fall, but the actual basing activity where a recovery can take place, is roughly 15 months, so just over a year. So 20% down and roughly a year of a decline and a basing formation. That's what history teaches us usually happens on sterling dollar.
Yeah. Okay. Let's in that case go back now to take a look in some more detail about your target. There's still I don't know how much of a percentage there is to go before we get to the bottom, but I think if we can bring up the next chart, we can then go and take a look at where we are now and how much further we've got to fall.
Well, the analysis that we're just looking at of historical price slumps on sterling dollar suggests another 5% down, maybe even greater the more we rally up in this oversold reaction that we're getting. So the further higher we go, the bigger the drop on the downside. So at the moment, 5% into 115. 115 is the minimum price target. These are just averages that we're playing with. Of course, the market can deviate in and around those averages, but it gives us a good yardstick to keep in mind. And what that does suggest is a move down to 115. That also ties in with the price patterns that we're seeing to date. Now, even if we're looking at the chart for the first time, any market bottom after a market shock takes time. It's all about psychology. Confidence needs to return back to the market, and what that looks like in the price chart is more of a basing price action that takes several months to take place, especially after such a big historic fall as we've seen now. That takes us into the end of this year, maybe early 2017, which also coincides with the 8-year cycle, which I'm watching very closely.
Yeah, the interesting thing about all this is that moving away from the technicals, the fundamentals all of a sudden become very different, don't they, for the British economy and those especially that are earning money from abroad. And this is the sort of thing that's going to stir heat within the economy, which could ultimately see the pound recover, presumably.
Well, one of the things that we encourage people to do is to, when looking at the chart, look at the underlying sentiment and how that adjusts to that new price equilibrium. And if it does adjust pretty quickly, that is a positive sign, and that's what we are seeing. I mean, the negative sentiment before the actual EU referendum was so polarized on both sides, and now all of a sudden, I mean, the mainstream but also government rhetoric has become quite constructive, and as you mentioned there, the three main points that I've seen which have been quite beneficial about having a cheaper currency: one, cheaper, more competitive rates for our exporters; two, lower prices, assets for overseas investors; and third but not least, a much lower, narrower current account deficit. The BOV just suggested that might be actually a third lower than it was before. So this is the underlying sentiment, mainstream and government, which is maybe aligning with this new equilibrium. So it's a good sign of a market bottom taking place in the coming months.
But you said, yeah, coming months, so you suggest potentially by the end of the year we might have seen the bottoming out at 115.
Yes, and watch for that basing formation, watch for false signals on the upside, a retest of prior lows. That's usually what happens. No straight line moves. Things take time, especially after a market shock. Good.
Okay, all right, Ron, thanks so much indeed there for that. Ron William from ECU Group there talking us through his thoughts in terms of the moves over the next few months for sterling dollar.